everybody. I know it's morning here on the West Coast, but it's definitely late afternoon in London. Dr. K, you there?
I'm here.
Dr. K is here, and all of you are there. I know on the East Coast, we're just pushing into the 1 o'clock hour. We're doing a midday webinar just for fun today. The big news is Greece, the vote tomorrow. And the other reason we're doing an intraday webinar today is because I'm going to be on Fox Business News at 1:05 debating whether Greece is meaningful or not. And the short answer to that is, of course, it's meaningful, and I think it's meaningful in terms of the psychological aspects of what's going on there. Losing confidence in sovereign debt issuance is going to be an issue, particularly when the whole world has borrowed and spent way, way too much and needs to start cutting back. And this whole business of just kicking the can down the road and borrowing more money to pay off old debts is just kind of getting out of hand. However, they can continue to kick the can down the road, and we'll kind of discuss our take on it. One thing you do see a lot of, or you hear a lot of, is that Greece is the economy is the size of Maryland. It's the size of Alabama. It doesn't matter. And yeah, that's true on the grand scale of things. If we lost Greece, if somehow Greece separated from the Earth and went careening off into space to become part of the asteroid belt out there between us and Mars, yeah, that probably wouldn't be a big deal. But this is the issue, and this is what I will bring up this afternoon when I'm on Fox, and that is very simply, yeah, you can compare Greece to Maryland and say, oh, it's no big deal, small economy the size of Maryland, what are we worried about? Well, think about it this way. This is the analogy that I think is meaningful, and that is simply that if Maryland was in hock for $240 billion to U.S. banks, how the hell is Maryland, pardon my French, but how the hell is Maryland going to pay that back? And how is Greece going to ever pay their debt back? They're not. So the only thing that can happen here is money printing, or as we like to call it now, Euro QE, which may be the next wave of QE that comes down the pipeline. Now, we put out a note on the short sale setups service, part of our website, on Friday, and we pointed out that the market looked like it was in position to rally. And of course, that's exactly what's happening. Now, is this a meaningful rally? So far, you have not seen any kind of follow-through action today. Dr. K's conclusion today is that any follow-through today would be very, very fishy. And you can see here, you got my chart. Can everybody see my chart okay? They can. All right, thank you. You can see you got the bounce off the 200-day. Now this area I think in here is a zone of resistance, maybe from down here, just above the 2700 level, up to this area of congestion close to the 2750. Now you might rally further up into the 50-day, but right now all you have is a reaction rally after this low. And there's something I would point out, and I've talked about this before, and that is when we go back and look at what happened when QE1 ended. This is a chart now of last year, in 2010, and you can see when QE ended, we had a 3-day break that was about 13%, give or take another 0.5%, and the market broke down in pretty much 3 days, and that was very rapid descent. It was fostered by the flash crash on May 6th, and basically washed all the selling out in the near term. The thing bounced very sharply right up into the 50-day and rolled over. Then we undercut the lows and flitted about or oscillated about the 200-day moving average for about the next, about the next 2.5, 3 months until we broke down, going at the end of August, tested these lows. This was actually a nice playable move here on the short side. But basically you were oscillating around the 200-day moving average, a lot of volatility, and then you came out and we started the new bull market with a follow-through day on September 1st, which I believe is right here. Is that right, Dr. K? Do I have it right there? I do.
That's right.
Anyways, and really, that's on the long side, that's where you're going to start to make real money. Is when we come out of this and we start a trend. Every time I go on TV, they want me to have something to buy, want me to be bullish, and of course, everybody on TV is a perma bull. And every time the market's down, everything's on sale. But they kind of miss the point that when you're dealing with a portfolio, you should be running your portfolio like it's a business. If your products aren't selling well, then you want to get rid of them and have the products that are selling well. It's the old red dress, yellow dress story. But I love it the way a lot of these guys think. Every time the market breaks down, you got to get in there and start buying. And of course, television promotes that simply because bearishness doesn't sell. Bullishness is what keeps people interested. But I would argue that a nice correction here, a nice bear market, or a bear phase would be very nice to see to set up, clear the decks and set up some new situations. That said, there are some stocks that have been breaking out. Basically, the way you're looking at this right now, you are now in 1, 2, 3, 4, 5, 6, 7, 8, ninth day of a rally. So you're getting a little bit late here for a follow-through. But it could happen, and we would consider it to be somewhat suspect. But you can see the market is basically rallying because it tends to look at the Greek solution as being a nice, feel-good situation. But really, what you're probably looking at is Euro QE and money printing. But I don't think it's really been resolved yet. Some of the European banks, particularly in the United Kingdom, are pulling liquidity, drawing money out of the interbank lending system. And if we go back to 2008, that's really what caused the problems in 2008, was when banks stopped lending in between, amongst each other in the interbank lending system, which banks use overnight liquidity to meet certain obligations. And when that all freezes up, that's when the system started to have problems. And I think that may be what you start to see with the Greek situation. And that's the danger, and that's why Greece does matter. So it's also the tip of the iceberg of more of these pigs, which, they could have come up with, I guess, a nicer acronym for them. I don't know what, the GIPS or something. But, the bottom line here is that Greece matters, and what's going on in Europe matters in terms of liquidity. My view is that the sharp break that you've seen coming down to the 200-day moving average is about a 12, 13-day break, is a sign of forced selling. And you see things like gold start to come apart. Yesterday, breaking down and undercutting the low of Friday, I believe it was, to establish a violation of the moving average, and hence a sell signal. And so, we exited. We had a small position in the DGP, and we exited here. Now, it may set up again. We're fine with that. We can take 5% hit on that if we have a 10 or 20% position, because that's only going to cost us 1/2 to 1% of our portfolio. So we're okay with that, and we'll sit here. You're finding support at the 65-day exponential, which we'll find out if that's meaningful. But basically, on the GLD, our view is you want to be out. We're out. We're not going to try and get fancy here and play a bounce. We'll look for the next reentry. So we take a small loss, and we move on. So we're sitting in cash right now, essentially, waiting to see how this movement off the 200-day moving average pans out. Okay, so intraday, you see the Dow is up 122 points, Nasdaq's up 33 and change. So we're basically getting it up to about 1.24 here percent on the upside. We need to see 1.4 on heavier volume. Right now, I believe the Nasdaq is trading slightly heavier volume. Is that right, Dr. K?
No, we're slightly less volume on the Nasdaq, slightly heavier on the S&P.
Slightly heavier on the NYC. Okay, so probably then, let's take a look at the S&P index here. You can see this rally is a little weaker because you're still constrained here by this resistance, and so this point here becomes a point of resistance for the S&P, and you're trading a little more volume, but it is actually in the weaker technical position. So net, it's just a bounce. You might fiddle around here for a little while. Our take is that at some point you'll probably see the S&P break the 200-day, maybe undercut this low, but we'll see what happens. You could get a follow-through day here, and that would change the whole picture, at least in the near term, and potentially we would then be looking for this area on the S&P around 1316, where the 50-day moving average is, as the spot for a resistance to come into play. And you can see this would take you right up well into this area of resistance between this point and this point up into the 50-day. So it looks like that's a potentiality. So really the only thing to do here is stop out of GLD. That's fine. Take a small loss. We're doing fine for the year anyway, so we don't really have to worry about it. And if you had some shorts, what I would do is simply stick to your stops on the shorts. And let me go through some of these short ideas we've been talking about recently. And as we wrote on Friday, a lot of the hard side of the watermelon, to a large extent on the short side, when you have that breakdown and it gets pretty obvious on the downside, now what you need to do is get everybody excited again on the upside. Okay, so let's just go through some of these real quick. You see Apple, that rally is very normal as far as I'm concerned. Really, a move from 310 to 335, 336 is not even 10%. It's real nice, real small, nice little bounce here, right up into the 50-day and the 65-day, which are creating a kind of a band of resistance as I see it. And I kind of look at Apple as being potentially shortable here. I'd watch the general market, see if it rolls over. But I still feel that Apple, longer term, has probably seen its best days. And one of the things it reminds me of is, excuse me, it reminds me of Cisco in 2000. And let me just go back. This may take a while. Let me just go back and see if I can shrink it to make it a little quicker to get there. Let's go all the way back to the year 2000. I'm curious to know how many people were trading in 2000. I know I met a lot of people who started trading in the early 2000s, which I feel sorry for you guys because you missed the wonderful parabolic bull market of the 90s. I started in the early 90s, so you know, in some ways, you have to be in the right place at the right time. And of course, I think you create your own luck in the markets. But Dr. K and I were both very lucky to experience the 90s as our first decade of trading. Okay, I want to show you. Here's Cisco. Let me see if I can make this a little bit plumper here so you can see what's going on. This is a top in March of 2000 in Cisco. And Cisco started to go sideways. It wasn't really going anywhere. Of course, the whole market was starting to break down. You had a rally in June, at the beginning of June. I'm getting an alert over here. That's what you just heard. But you had a rally at the beginning of June when there was a follow-through day. I remember Dr. K and I were doing a workshop with Bill O'Neill in New York. We had 2 stages, 2 screens, and there were over 700, 800 people there. It was like a rock concert. And of course, that was in June of 2000, which was the ultimate top of the market back then. What you notice here is that Cisco tended to hold the 200-day on the pullbacks, and then finally it broke down and flipped back and forth in here for a period of time, and then started to break down. So if you keep that picture in your mind, you can see Apple, to me, looks like that. Now, I could be wrong. Maybe it isn't. It's going to set up again and go higher because it's so wonderful, and the iPads are going to take over the world. But I tend to think this is starting to look a little bit like Cisco in 2000, and I would wonder why, with all the good news, Apple hasn't gone anywhere since January. So really, what this one's doing right now, you're actually in a shortable position. Watch the market today. If the market starts to roll over today or tomorrow, then you come back on this as a short. The other thing here is that you could have been covering down here because you did undercut this low. So that's kind of undercut and rally. It makes everybody think that you're breaking support here. You're breaking the 200-day, so you're going to break down. But it actually comes right on top into this little area of congestion here. So that's a logical place for it to bounce. And percentage-wise, not a lot of movement there on this move from here to here. But I do think it sets up potentially a short sale situation right here if you want to come in on the stock and the market starts to roll over. Okay. One of the stocks that has not hit its stop is NTAP. You notice how it keeps bumping up against the 65-day moving average. I would use the 50-day at 51.70, which is the average that we've been talking about as your stop on NetApp. Some of you may have heard of the new IPO, Fusion.io, FIO. It's, I think it's Steve Wozniak is involved in that company, and their technology for data storage in the cloud is somewhat revolutionary, and we think it puts pressure on companies like NetApp, EMC as well. But FIO recently announced a new product that they're rolling out in conjunction with VMware. And you notice VMware is trying to break out. This could just be another failed attempt and the stock breaks down. But for now, this is kind of constructive. I like the way this is acting. So I have VMware on my buy list, watch list right now. We're also watching this FIO, or Fusion.io. It's still early in its life, and we think it needs to form a base. So one thing we noticed about FIO is that it is kind of an IPO U-turn, a little bit like eBay back in '98, I think it was. But this has time, so we'll keep an eye on this, and we think this is a very interesting situation. But getting back to the short side, Las Vegas Sands is now rallying up into its 50-day moving average. So you can see that from the perspective of where these things are moving up into. These are logical places for them to rally up into. When the market bounces off of its lows, it's going to take a lot of these back up. So this may be shortable in here. You kind of watch that with the market. Finisar was another one we had talked about. This is your model situation as far as being the perfect short sale setup. We look at the weekly chart here. Let's see. I'm just going to sort this out here. But you can see here's your left shoulder, here's the big break, here's the right shoulder, and this thing breaks down very nicely. Even goes lower on earnings, and so that's really the type of situation you're looking for as a perfect short. So that one's pretty much played out for now. I think that's pretty much all that we've talked about on the short side. We've been very selective. Really, the short side of the market probably kicks into gear if we get another leg down, and that may take some time to pan out. If you recall, in 2008, we broke down at the beginning of the year when Lehman and Bear Stearns all went under, and then it took all through summer before everything consolidated and then broke down again. You had this massive break to the downside, and maybe you see that now, but we'll see what happens. It's still all very much in flux, and for right now we're just kind of watching and looking at what happens. But you can see that you have Apple, NTAP today rallied into logical resistance, LBS rallied into logical resistance, and all the stocks basically are pushing right into logical resistance where they could become shortable. So you want to be alert as far as all that is concerned. Now on the long side, today on Fox I'll talk about Illumina as one of the few stocks that I like here. Yesterday you had a pocket pivot. We pointed that out to everybody. Stock's higher today, and it's actually trying to break out. I don't think, though, that volume is all that heavy. You're running right now 2% above average, which is not sufficient for a clean breakout. But it's showing some strength. It's also roughly tried to hold the 50-day. And notice that since the market top, which was in early May, it's held it pretty tight. So this is one I think you want to have on your watch list. We also pointed out Fortinet, which has had pocket pivot buy points coming up through here, and now it's going higher. Another one that we looked at earlier was Biogen, which had a pocket pivot here, which we pointed out to everybody. And we thought this was a viable gap up. And if you recall last week, we were talking about Biogen going up to the 100th price level, and that might invoke the Livermore century mark rule, which you're all familiar with by now, I hope, is basically Jesse Livermore's rule that when a stock for the first time goes through one of those century marks like 100, 200, 300, it should move up through that and move up with some force. And you notice that we're running up to 107.45 on Biogen. So my guess is, as long as this rally remains in force, Biogen probably keeps rallying. As soon as the market rally gives way, assuming it does, and we don't get a follow through, then I'll probably have to pull in and consolidate. But this is another stock that should go on your buy list, primarily because it's acting well when the market is not, and that's pretty much what we look for, contrarian strength. Now, I also think it's interesting. Let's look at the Biogen chart here. This is a weekly chart of Biogen going back to late 2006 over here. But you can see this. If you look at Biogen, really, okay, here's a prior peak. This is a nice climactic type run before the thing topped out. But if you look at this, you're breaking out to about the 85 level here on this huge gap up. You pull back in here to the 10-week, which corresponds to the 50-day moving average on the daily chart. And now you're moving up to new highs. So if you look at it on a long-term basis, this is very constructive because Biogen really is only about 20% out of here, roughly, maybe a little more. But it's gotten out of here pretty quickly, and it's acting very strongly. So this is definitely a stock that, should the market right itself and start a new bull leg, which we don't think is the greatest possibility, but you got to be open to anything happening because usually things happen when you least expect it. I can remember in October of 1999 that Bill O'Neill called me, or actually it was October of 1998. It was like October 23rd, as I recall, from my trading diary, and it's actually in our book, Trade Like an O'Neill Disciple, where Bill called me up and said this market is through, and things look terrible, and they did look very terrible at the time. And then 5 or 6 days later, boom, we had a follow-through day. We got long things like AOL and Schwab, and the market took off. So my point simply is, you got to be ready for anything, and don't assume anything, and just be ready to move with the market when the time and place is right. Okay. So my point here on Biogen is that you're just coming out of this long consolidation, and it looks pretty decent. Dr. K, you have any other names that you're watching that you like right now?
There's one that cropped up today earlier. It's the 4G maker SQNS, Sequans Communications. It looks to me like well, we only have less than 3 hours left in the trading day, so it may or may not hit its pocket pivot volume here. So I'm watching the volume based back on the 17th of June. It has to pretty much exceed 900,000 shares today to qualify.
That's
I
right.
like the story behind the company, and this could be a viable buy point. On the other hand, I often like to see a stock face a little bit longer because it went straight up and went straight back down.
Right. But that's one that looks like it might be shaping up. I did notice Netgear breaking out this little flag formation. I'm not sure if volume is all that hot. Well, you're running 36% above average, so it's not terrible. So it's actually not too bad. So there's a breakout. You know, and the market does follow through, then I guess these would be your best spots to go after. And if you've been brave, it's possible also to play Biogen and Fortin. I played some Biogen the other day and made some money, a few bucks, and then bailed out. And of course, it goes a couple of bucks higher. But in this environment, it's very difficult to hold on to long positions because if the market starts to roll over again, it's going to drag everything back down with it. And that's really the major issue here. In terms of stocks that are up on volume today, not a lot of situations out there that we really like. And so, you know, not a lot that we're seeing that we would just dive into this market. The things that we've pointed out, Fortinet, Biogen, Illumina in the last few days, those have been pretty decent stocks over the last few days, and they've moved up with the market bouncing off the 200-day moving average. So really, that's where you're at right now. I've gone over the short sale ideas where I think you can put these out as they rally up into the 50-day, and then of course you're using the moving average as your rough guide for a stop. You can do 3 to 5%. Sometimes I just use the moving average. If it gets through the moving average, I'm out of there. I'm gone. And I will come back and test stocks on the short side repeatedly until something sticks. And sometimes you do have to be persistent. And I would say, you know, in the situation, or in the case of Apple, you know, you could be shorting it here, but it stops you up pretty quick. And you know, it moves around, but it's really like 1 or 2% move. So it's really, percentage-wise, not that much. Now I think you're in a primo spot here to be shorting it. It's very possible I'll be putting out a position by the end of the day. I was trying to short it yesterday on this move, but it just held above the peak of the prior day, and I just bailed out. It didn't really work out. Lost a couple bucks on that, but that was very tolerable. But you can see you may be in position here, and you can see that sometimes these short sale situations will give you a clue that the market is in a spot where it could roll over, and then these begin to work. So be alert to this. I think this is potentially a short here. Be alert to LBS, and be alert to NTAP here. And these are still pretty weak. So, you know, NTAP's pretty weak today on a day when you have the market up, the Dow 117 points, the Nasdaq up 1.2%. So not too bad. So what we're going to do now is go through some questions, and I'm sure everybody has a ton of questions. Let me just see what we got here in the queue. Oh, we got a lot of...
Yeah, I've got a few as well.
Let me go through some of these, and we'll try to answer them as quickly as possible. Okay. Following QE2, the Fed will buy securities with the proceeds of securities that expire or pay dividends. This is significant. My view is this. QE2 has been proven to really not help the economy very much. It does a lot to prop up and push up asset values like stocks and gold and silver and commodities, but I don't think it does anything for the economy. So really the Fed is pushing on a string with QE2 unless there is some you know, abject move to implement QE3 in some meaningful way, and they're going to go hog wild by dumping more liquidity into the system. QE3 may not really matter if they're just going to be reinvesting the proceeds of principal and interest payments. So that's our view. But ultimately, the market is the final arbiter of any of this, and so you don't really need to worry about intellectualizing it. That will be one point I make on Fox today. I think the Greek situation is fascinating, and a lot of us are witnessing some very historically significant events. You know, 2008, what we saw happen there, Bear Stearns disappearing in the blink of an eye. Lehman Brothers, a venerable old firm like Lehman Brothers going under. Merrill Lynch having to run into the arms of Bank of America because they were stupid enough to issue $50 billion in credit default swaps. You know, all of that stuff has been historical, and I think that what we're seeing now is very fascinating, and you can intellectualize and debate it all you want, and it makes for great conversation, you know, on a Friday afternoon when you're having a beer or a martini, as Dr. King and I like to do. But ultimately, the market is the final arbiter, watch the market. Opinions are nice. They make great conversation at cocktail parties, but in the market, you just watch the market. Let's see. Do you feel that the dip is primarily related? The goal. Okay. Here, let me. One of the things I don't like about GoToWebinar is where you ask a question, it gives us very little space, like one line, to read your question, and so we have to scroll through it. Following QET, blah, 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 okay. In the past, your outlook on gold was to buy it on weakness rather than strength. Is it different now because you feel that the dip is primarily related to forced selling? I think you've got to sit back and just wait for your next buy signal in the metals, and that will come. I wouldn't try to buy on the dips because, yes, if the market continues lower, and the Wall Street Journal reported over the weekend that a lot of hedge funds and other institutional investors are dumping positions in gold to meet margin calls or to raise cash to cover losses, etc. And that's really the nature of forced selling. So I was on Stuart Varney's show on Fox Business last Thursday, I think it was, and I said quite frankly that, yeah, forced selling will drag these down. What's been interesting is that gold and silver were down yesterday while the market was up and the dollar was down. So I don't know what was going on there. Maybe some rotational selling. But we would just step aside and wait for another buy signal to show up. So
it could be some seasonal weakness in the precious metals, pretty typical from May, June, July for gold. So it could be part of that. In the summer months, there's less demand. But it also could be some other factors. There's a couple of bearish factors out there. Would be China's weakening economy and also the PIGS debt problem, which can cause countries to sell their precious metal holdings to raise cash to meet payments and margin calls. So that can put a temporary pressure on precious metals.
Somebody asked if Friday is going to be a quiet trading day. I don't know. That depends on what happens in Greece, I guess, on Thursday. Typically it is. Generally, the day before a long July 4th weekend tends to be quieter, or any holiday weekend. But we'll see. I think a lot of it depends on what comes emanating out of Greece. So, a question on FCX. I mean, FCX is a stuff stock. It's in a base right now. It looks a little weak. It's below its 200-day moving average, and it's been living below the 50-day moving average for about the last 2 months. And you'll notice now that the 50-day moving average has crossed below the 200-day. I don't know if I would call this a head and shoulders pattern because the right shoulders are above the left shoulder here, and that tends to be a less weak pattern. So I'm really not messing with it right now. Stocks that have acted well. Somebody asked about Fossil. This is a stock that continues to act well. And, of course, it's a lot like Lulu, and it's a lot like UA. These are just holding up pretty nicely. UA is trying to break out. I think one of the factors here is you have a lot of short interest in these, and this is probably what is creating the upside in the short term. They're squeezing the shorts, especially with the market rallying the way it is. So that's kind of how we look at all three of those. And Lulu is on fire. This thing is an amazing stock. Lululemon, I guess. I like to call it Lululemon, just to kind of make fun of it all, since I think it's incredibly overpriced yoga wear and workout wear. But I live in West LA, and it never ceases to amaze me how much people will spend to wear the most trendy stuff. It's also one area. West LA is one place where you'll see more SUVs with bumper stickers saying "Think globally, act locally," which I think is kind of ironic. But in any case, that's why I like to make fun of Lululemon Athletica. But it's going higher. So I tried to short a little bit here, but I got blown out of that very quickly. And the moral of the story here is that while you could have played the violation of the 50-day moving average here on the premise that it would not get back above the 50-day, once it does, you're gone. And the other thing is that this was not as weak a pattern as, say, Finisar or even Apple or Las Vegas Sands. So when you're trying to short a pattern that is not so weak, sometimes they'll break very sharply for you. It's very gratifying off the peak. But a lot of times, if they start going against you, you've got to run out of there quickly because they aren't that weak and they can turn into a much stronger pattern. And to me, this just looks like shorts getting their heads ripped off. Watson Pharmaceuticals, is that what WPI is? Yeah. That's looking good. Trending higher. Got a breakout today. Volume right now is running above average. already on the day. I think you're looking at 73% above average. So it's acting fine. I don't know if this develops into a pocket pivot, mainly because of this day here. But notice how you did close off the lows. So you might almost, hey, Dr. K, would you 3 days ago on WPI, would you view that as a pocket pivot based on the fact that it has a long lower tail and held the 10-day moving average?
Well, it's a close call. I mean, it has a tail. It held the average. It was off still. It was off 0.3%. So you could say that was a day of support. So yeah, I guess that would qualify.
So that might be a pocket pivot. So it looks good. If you own it, it's fine. So
well, part of the reason also it had that high volume is because of the Russell rebalancing.
That's
so
right.
I would want to know what the actual volume was before the rebalance. If it was higher than the day before.
Yeah, and that kind of skewed the action on Friday because of that Russell rebalancing. It threw a lot of names off. In fact, I was wondering, Fortinet, huge amount of volume. I don't know if that's right, but I guess that's what happened on the rebalancing, and the stock pushed out to a high on Friday, and it's continuing higher today. So not too shabby. Let's go through some more names. Ultra Salon or Ulta Salon Cosmetics and Fragrance. Yeah, I don't know. I don't buy a lot of makeup myself. How about you, Dr. K?
I'm well stocked.
Okay, good. Good to hear. It looks okay. It looks like it might be stalling a little bit here, but you want to use your stops on this if you own it. But for right now, it doesn't look like you need to sell it. We talked about Lulu, UA, Tiffany. Beginning to think Tiffany is a hard asset stock. There's been some talk in the media that individuals are stocking up or putting cash into diamonds because diamonds are a hard asset. I don't know. I just always thought diamonds are a girl's best friend and my worst enemy, but or rather my wallet's worst enemy. And I have to a little personal story. When my wife and I were going to get married and I proposed, I actually bought a ruby wedding ring, and when she lost that one, back when I was making $2,000 a month as a Merrill Lynch broker, she lost that one several years later, and then I bought her a big fat ruby, which she lost again, and I had to buy a diamond most recently, and then she found her original big ruby underneath the washer a few weeks ago. So we picked up, as I look at, we picked up a whole ruby to add to our collection of hard assets. But Tiffany looks fine. You had pocket pivots in here, down in here as it was coming up, and it just continues to truck higher. This may be a hard asset play. Our outlook for gold, is somebody's asking, they would be interested in our thoughts as far as the outlook for gold goes, and we don't really have an outlook. It's going to have to show us another buy point, and then maybe we'll have an outlook. Right now, we're not even watching. Well, is it up on? It's up on my screen, but I watch all the commodities, including soybeans and cotton. And you can see some of these coffee down here on the KC #F. Coffee moving up.
That dovetails well with this question. Shouldn't the inflation in China and India drive residents to gold and overcome the potential deflationary pressure in the U.S.? I'm still bullish on gold and silver. Well, my answer would be that the falling dollar and inflation in China and India are driving those countries to gold, but that's only one factor. And I noted earlier during this webinar that we do have some factors that could pull down the price of precious metals. We also have a couple factors that are bullish as well. As we all know, quantitative easing in Europe due to the squealing pigs and potential QE3 through the Bernanke has yet to hint on when. Those are factors, of course, that can push metals higher, precious metals higher. And also, interest rates right now continue to be at a record low, while inflation is a potential issue down the road. And that would be indicative of stagflation. And some of you may remember that the 70s were such a time and very bullish for precious metals.
Yeah, so bottom line then is we think long term the potential for more upside in the precious metals is definitely there, particularly if the global the sovereign nations around the globe don't settle their debt issues and actually start paying things down. I think that fiat currencies are doomed. And as I pointed out to Stuart Varney last week on Fox, how many fiat currencies in history have survived? Well, none. And so why should the dollar? How's the dollar going to escape? Now, maybe something happens along the lines of what Steve Forbes predicted a few weeks ago, which is that in 3 to 5 years, you're going to see the U.S. dollar backed by gold, and that's potential as well. And if that happened, I'm not sure how that would affect the price. It'll probably make it go up, depending on whether or not the U.S. government decided to confiscate your gold. So,
well, they could pull another one of those. They could set the price of gold, peg it to the dollar, and that would be basically an incredible tax levied against people just by virtue of saying, okay, we're going to peg the price of gold now to $400 an ounce pegged. And so it virtually wipes out all, it basically translates all that wealth, which is made up in the price difference, into the hands of the U.S. government, which is what they effectively did in the 1930s.
Right. So
I wouldn't put it past the U.S. government to do something like that.
No, I would never underestimate the ability of politicians to be heinous, slimy, and well, I'm not going to go on with the rest of the dirty words I have in mind. But you guys can all make up your own. In fact, if you feel like IMing them on the GoToWebinar questions box, go for it. Let's see. Easy PW. Okay, pawn shops. Yeah, it's a breakout. Looks like a nice breakout. Thin stock, breakout. Pawn shops. Everybody's going to be pawning off everything pretty soon. TIBEX. No pocket pivots in TIBEX, mainly because you're not coming off. It's kind of straight down, straight up. It looks like it's on track on the day to have a pocket pivot, but this is too V-shaped, I think. But we'll defer here to Dr. K. What's your diagnosis, Dr. K?
It's when you have this straight down, straight up formation. It's more vulnerable to pulling back before going higher. So I'd be pretty cautious here.
Yeah, I do like the story. I think it's a great story, and the fact that it is holding that, maybe it continues to build a base. I think this could be a future leader in a future bull cycle or bull leg up. What do you think of something like Nike? Just do it. That's what I say. I don't know. That is a pocket pivot, but the problem here is you have these big gap downs in the pattern. So I think if you're looking at something like this, you're better off going with one of the more quality retailers. Among them, Tiffany, Lulu, UA, Ulta I would classify as a retail stock, and then of course Amazon I would classify as a retail stock. Yesterday Morgan Stanley came out and put a $240 price target on Amazon. Okay, I'm down with that. If they wanted to, I guess you can put any price target. I'll make mine 241. I don't know when it's going to hit it, but for whatever it's worth. The stock got some good volume. I would have liked to have seen yesterday's move occur on more of a pocket pivot type move, but it did exceed the volume back here, which I think is about 9 days ago. But that looks pretty good. But that's where I would stay rather than trying to pick up one of the laggard retailers, if in fact that's what you're trying to do. Okay, here's a series of tickers here that I'm going to go through. Yoku, that's a dog. It's coming straight off the bottom,
Yeah, they basically got a deal. They got a deal today with I think was it MGM, one of the major movie houses. That's why there's so much excitement in the stock. And I mean, it is indicative of there's certainly a lot of potential with this stock and what they do, which is why it went from 30 up to 70 shortly after it was IPO'd. But obviously, to buy something that is this far off its peak, you're looking for a lot of volatility, and therefore that translates into quite a bit of risk for the position. And on this news, I remember seeing it, and I thought, I could take a small position here, and if I did, it would be up quite a bit. But my thinking, keep in mind, my thinking was, if I'm going to do anything with this stock, it's going to be a tiny little position because it's going to be volatile as hell.
Right, and you have a pile of overhead over it. So all the way up, you're fighting against overhead. All the moving averages have turned over. It's just swimming against the tide, I think. But interesting move today. Sina or Sina, whatever. Sina was a short up here. It broke down. This is kind of a late stage failure. You have a climax top, which we weren't really sure if this was a climax, top at first, but this break I think confirmed it. And you get a really nice break. This is a great short on the way down. Bounces off the 200-day. Notice how it undercuts, gets down into this area of this little base here, and then bounces out. Now you're heading to the 65-day exponential right here, the black moving average. You could rally higher. This will depend on what the general market does. If the general market continues to rally, then it's likely headed for the 50-day. Otherwise, you might run into some resistance right around the 65-day or this price level, which I think is 104, 105 in here. And the 65-day exponential is 103.83. So kind of in flux right now. Let it bounce and see how it sets up. Now, the other side of this may be that seen as setting up in some kind of a head and shoulders formation. There's a left shoulder and here's a head. I would like to see this actually form lower, but this could in some cases an ascending neckline on a very volatile stock sometimes will work. So you might watch this as it heads up to the 10-week moving average on a bounce here. So, but if I were support around the 200-day, would not be going long the stock here. Goldman Sachs, I don't know, I saw some guy on TV on this day saying that he want to buy the stock here. I don't think so. It looks to me like it's breaking down and wants to go lower. One of the things I noticed, let's see, let's go to a weekly chart. This is a weekly chart on Goldman. You can see that what it's doing here is heading for support right in here, and it's starting to break down. To me, Goldman looks like a topping pattern. And watch this. If we go out further, if you look at Goldman here, this is a 2008 low when we broke down. And if this breaks down and we get into a more of a bear market here, this thing could head a lot lower. And if it breaks this support, I would expect it to hit a lot lower. It looks like it might be in position to bounce, but that's not really clear. It doesn't seem to want to. Here's a daily chart, and the stock is going lower even as the market is up, 1% across the board on the major indexes. So very weak. Looks like it wants to go lower. I would tend to look at the area around 131, 132 as near-term resistance. You've got all the moving averages rolling over. So it still looks ugly. If you were smart enough to short it up here, probably still a hold as far as that goes. Open table. Let's see, I've lost my typing skills here. There we go. Stock broke down. Now, see, this is a situation where you could be looking at a really nice short sale setup, because what you've got here now is a left shoulder, the big break off the peak on heavy volume. There's the head, okay? Now, I don't really call any of these a shoulder. Now you're forming the first shoulder. Maybe it comes up into, say, mid-80s, a little higher. You can see the 10-week moving average is at 87.25. But I would watch this, because if this forms a right shoulder here and starts to roll over, this is the sort of lean-to situation you're looking for. And these are the weakest patterns. Remember, like Finisar, that's your model, remember? I want you to look at that. There's the left shoulder, the right shoulder, and the whole thing leans over, right, with the right shoulder much further below. So open table, I've been watching that one. It's on my watch list on the short side, and I want to see how this finishes forming out the pattern. But yeah, this could be a short, not a long. So I hope you weren't asking about it that way. But it is fitting the model that I like to see. I might also mention Rockwell Automation is another one. Not your classic leader, but here's kind of a left shoulder. Here's your big head with the big break down the right side on heavy volume. See that? That's always your head. You're always looking for that. Okay. When you don't see that on the right side of the head, you see light volume, or it takes a shorter, weekly intraday ranges on the way down, and it takes a few weeks to come down, and the volume isn't all that heavy. Usually you want to see just a big 1 week break off the peak, and that will define the right side of the head. Now what you have is a little shoulder here, maybe another shoulder here, but you see this has that whole lean-to type of thing going on, where you've got a neckline down there, and maybe that's going to bounce. It's right up into the 10-week moving average of 50-day right now, and maybe this becomes shortable here. Notice how light the volume is. I think it's actually pushing right into a shortable position right here, and this is one I have on my watch list as well. So you can see with open table, OPEN, and with this one, you're getting this sort of situation where they're pushing into shortable positions and creating or forming out what I think are very optimal short sale setup patterns as far as head and shoulders go. Okay, Oh, I like this question. Do you follow Citron or Muddy Waters? I follow Muddy Waters. How about you, Dr. K?
Muddy all the way.
I don't know. What is? How about Dell? What does he follow? For those of you who don't know, Chris's dad, Dr. K's dad, Dell Casher, the inventor of the wah-wah pedal, an amazing guitarist. He's the only guy I've ever taken lessons from, and I'm glad I did because he has a very unique way of approaching the guitar. And the guy's just awesome. Everyone should go to delcasher.com, DELCASHER, and check out his old videos. He plays a piece on the Lawrence Wells, right, Dr. K?
Sorry, you blanked out there. What did you say?
He plays a piece on the Lawrence Welk show that's on his website on video. I think it's Black Eyes is the name of the piece, and I think that was like in the early '50s. And
yeah,
back at that time,
very early on, he was invited on, and then he was invited onto a number of other shows after that one.
Yeah, and what he played back then was pretty radical stuff. I mean, he was doing all that hammer-on stuff way before Eddie Van Halen ever thought of it. In fact, I think Eddie Van Halen stole it from your dad, but that's just my opinion. Anyways,
my dad would probably agree.
Riverbed. I kind of look at Riverbed this way. You had a big pocket pivot type move off the 200-day. Now you've gapped up. It's probably run its course here. I don't know. Maybe it's even shortable on a tactical basis if it comes back down into the 50-day. But that looks nice on this pocket pivot here, and it's pushing up. But sloppy pattern, I wouldn't be buying it. I might be watching it. The only problem here is if you're looking at a head and shoulders outside of just a tactical short, if it's going to retest the lows, you're not really leaning over. You're pretty much straight across on the neckline. And again, this is this formation where you don't see any huge volume spike as it comes down the right side. Now, the other question might be if you're trying to look at this bullishly, is this a double bottom formation? Well, this second low does not undercut the first low, so if it did break out, it might be suspect. So in my view, it needs to put in more time if it's going higher, but I think it could be susceptible to a sharp pullback in here that takes it back down to the low 30s down around these lows in here. So not really all that bullish about it. ARUN, well, here's your big break off the peak, okay? So now you have left shoulder, head, right shoulder, second right shoulder, okay? That's what it looks like it's forming here. And you're coming in on light volume, coming up to the 65-day. Maybe it goes a little bit further. I'd be watching this one as well. This looks like a very normal rally, and a lot of times they come down below the 200-day and rally back above prior resistance here. It's trying to get above this high here from May 31st, which was 28.98. Now you're working on 28.77 is the last trade. And this could run into resistance, so I'd be keeping an eye on this. And you do want to watch some of these stocks as they rally up at the market. Is the dollar likely to strengthen here with the end of QE2? Wouldn't that be headwinds for the market? Yes, I would say the dollar is probably going to rally. I think if you see a big bailout, there you go, Thorn. I'm with you. Aaron, ARUN, short sale. Everybody's watching that one. But the dollar's trying to rally, and it's not really clear where the dollar's going. It's kind of sputtering around here between the 65-day and the 50-day moving average. But I think if you had a big bailout package and they start printing euros madly, then maybe there's a fear bid that goes into the dollar. But trying to predict what the dollar's going to do here is very difficult, and I would basically just focus on watching the market and watching stocks rather than trying to predict the correlation move based on where the dollar is going. So I like this question. The Wall Street Journal was poo-pooing, I read that story yesterday, was poo-pooing the rare earth metal supply-demand situation yesterday, saying it wasn't all that tight. Are you still long-term bullish on MCP? Well, the one thing I would point out is we're never long-term bullish or bearish on anything. We just kind of go with the movement of the stock. What you see in MCP is it got support off the 200-day. Now you're rallying higher, but you got some nice volume in here on the way up. But it needs more time. So we're neither bullish nor bearish on the stock. We're just kind of watching it. We think the story is sound. I believe it's $9.39 a share expected in 2012, I think, or 2013 rather. So it's selling at 6 times forward estimates. Whether those are real or not is another story. But I think you just watch the stock. At this point, you're in position to form a double bottom, but that's not really clear right now. Right now, we just see kind of a bounce off the 200-day moving average. And there's no real reason to have an opinion about anything. You just kind of go with it and just watch how the pattern develops. And if you see a buy signal, then you come in and buy the stock again. And of course, if there's a pocket pivot, we'll let you know. So you don't have to worry. Don't think too much about it. Let us do the thinking, or rather than not.
Another QE question. It says, I'm puzzled when you said, consider that if the Euro members move forward with a bailout of Greece, then we are likely looking at Euro QE coming into play, which would likely lead to a falling Euro, a rising dollar, and perhaps some of this extra Euro liquidity coming into dollar-denominated assets. But my question is, shouldn't a Euro QE drive up European stocks, and wouldn't that suck away money from the U.S. stock market? Is the difference that the Fed's QE was a continual infusion of liquidity over an extended period, and that the Great Greece bailout, by contrast, is just a single infusion? Well, QE, whether it's U.S. QE or Euro QE, can drive markets higher. That's its tendency. And since markets correlate to a high degree, if Euro QE were powerful enough to make European markets rise, it would also benefit the U.S. market. And the Greece bailout is most likely an infusion over time in the form of QE in some form. But you can't forget the other pigs, which could also require infusions as we go forward.
Okay, I like that. Let's see here. Somebody asking about, is it true that you can get better fills at one broker than another? I really wouldn't know, because I don't really use the broker I use JP Morgan. I trade my account through an institutional broker, and we trade our fund through an institutional broker. And I believe that what we get is we have a system that actually sweeps, so it can hit any offer, any bid. So we actually have broader the ability to hit more bids and offers out in the marketplace by going. We have a broader range of whatever they're called, bids or offers, ETNs or whatever they're called, where you can hit them. But I know I probably got all that wrong. But if you understand what I'm trying to say, is that we can hit any number of bids in the market and go to all the different electronic throughout all the electronic trading systems. Yeah, in other words, I can hit any bids out there.
When it comes to ECNs, so.
Yeah, so ECNs, that's it. Thanks, Dr. K. God, that was escaping me. Brain freeze, that's what it is. Yeah, we can hit any of the ECNs that are up there on level 2. So, so we have that capability. So I won't know about brokers, but you could ask your broker how they execute, whether they use a sweep function or whether you're just going through, NYSE or ARCA or whatever. And ask them. But I don't, ultimately 10, 20 cents this way or that way in the long run doesn't make any difference, since you're trying to catch longer term trends in the market. We talked about TLT, the bonds breaking down today. This is kind of interesting with the bond market coming in. It looks like treasuries are losing their luster here. So this is something that's something to keep an eye on in our view, and could be telling you that there's coming weakness in both bonds as well as stocks. And so this rally, again, may be a shortable event. So I already outlined the stocks I'm looking at on the short side and what we can be looking at. ROK is a new one. And you're looking also at Open Table, and looking for that to rally possibly a little further to create a right shoulder. So that's kind of where we're at with that. I mean, weakness in bonds might be a tell, in other words. Short cat, I'm not short cat. It's not really the right kind of pattern, so I don't think I'd short it here. I'd go after those weaker patterns that are rallying. I think this ROK is one of the better ones, and I might put out after we're done here, if I have time, before I have to head off to the Fox Studios. I may put out a note on that on the SSS, or Short Sale Setups service. CRR, Carbo Ceramics. This is like a pocket pivot right here on the rebalancing. Stocks going higher. Is that you, Dr. K, with those weird noises?
Yes.
Okay,
that would be one of my many chat functions.
Okay. I like that one. It looks okay. It's coming out of space. It hit a pocket pivot, so it looks like it's acting okay. Not too bad. On the weekly chart, it's holding up tight. It has had a long run, so be mindful of that. But so far, it's acting okay. I don't know. What is FCFS? What's that?
I was going to say, here's a question, and it actually relates to something someone else asked about the MDM. Finish up on FS, and then I'll address
For
it.
cash financial, isn't this another pawn shop? Sounds like it's similar, where people with no money do things to get money, and maybe there's going to be a lot more of those as this economy gets worse, which it appears to be. Looks okay, but not anything I'm really interested in right now. Fortinet we talked about. You have the pocket pivots. Any thoughts on window dressing before quarter's end? Oh, come on, you know that doesn't happen. Fund managers would never do anything like that. Who knows? I guess there's window dressing going into the end of the quarter, which is also the end of the mid-year period. So, would you still hold your end tap short? And if yes, what would be the stop loss? Well, as we talked about earlier, yeah, you could be holding your short end tap. Right now, I'm not short end tap, but I'm looking possibly to get short end tap here. I'm waiting for the market to give me the signal. If it starts rolling over, then we might be coming after that. We talked about GS. Baidu is interesting. It's bouncing. Nice bounce. Could be a double bottom. You don't know. I don't think it's running a lot of volume today. 7% below average right now, so may run into some resistance just past the 50-day. Not a buyer, and not necessarily trying to short it. The other thing with Baidu is if you look on the weekly chart, you don't have that major volume break to make a head and shoulders. I know some people think they see a head and shoulders here, but you don't have that big volume spike, and I just want to beat this one into your heads. This is what you want to see. This is what you want to see right here. See that? Nice big bust wide open. We had that in Finisar. You've got that in Open. See that? It's beautiful stuff. Beautiful stuff. ROK has it to a lesser extent, but you get that big break. That's what you're looking for. Is DECA short? If it goes lower, it is, but if it doesn't, it's not. So I don't know. This thing is just kind of wobbling around, not really decisive one way or another. Let's look at it on a weekly chart. It doesn't really have the features you're looking for. So it might be, but I don't know. With strength in other retailers like Lulu, I'm not so sure that's the group to be going after yet. It may be, though, at some point. Not right now, though. Accenture, they were added to the F100 yesterday, so that's one of the reasons why it's gapping up. So not really interested in that stock. I would note that Accenture is in a partnership with TIBCO. And one of the things that makes me like TIBCO with respect to that particular news in terms of the partnership with Accenture is that it gives them access to Accenture's platform of customers and therefore broadens the reach of potential buyers of their products as well. So I think that's very positive for them. TDC, looking Teradata, I don't know, it's going higher. Looks okay. It's just trending higher. Another stock I'm really all excited about. But they are in the network storage or data storage group. In fact, I think Teradata is one of the few that's acting well and has been moving up. FIO, Fusion IO is another one. Meanwhile, you got NTAP is floundering and EMC is floundering. And I really think NTAP's probably a short here. He used the 50-day as a stop at 51.70. Somebody's pointing out. Well, we talked about CMG when we put out the pocket pivot moves. I think it was last week. That this looks like an ascending base to us. One pullback, two pullback. But here's something I would point out, and this is why I think you could call it an ascending base, but it's all kind of semantics, right, Dr. K? I mean, trying to label bases is not necessarily going to yield any hard, concrete answers, correct?
Right. I mean, it can throw you out of your position or from getting into the position.
Right.
You really just want to be able to size up the big picture by looking at the stock chart against the general market averages. And then if you do this enough, you'll get a sixth sense of, okay, this stock is very powerful. It really wants to go higher relative to the general market. That's really what you want to focus on rather than putting labels on all this stuff, because that's
right.
It's good in the beginning, but eventually it's noise and it's going to confuse you. Because you could argue a lot of different patterns in some of these formations.
Yeah.
So anyway, yeah, CMG has just wanted to go higher in the face of a market that's been pretty difficult and choppy this year.
Right. What I would point out here is, look, this breaks out and forms a 1, 2, 3, 4, 5, 6-week brace, breaks out again, moves to a high here, then forms a 1, 2, 3, 4, 5-week base and breaks out again. Now forms a 4-week base and breaks out again. What do you notice here? You got 6 weeks, 5 weeks, 4 weeks. So maybe the next one will be 3 weeks and it'll go higher and form another one with 2 weeks. I don't know. But my point here is that I think these are just bases, and they're just regular bases, and it's breaking out of each of these little bases. Whether you want to call this an ascending base or not is irrelevant. When I worked for Bill O'Neill, he always would point out to me these patterns where stocks run up, move up a little bit, and go sideways, and run up a little bit, and go sideways, and they'll do that, and they'll basically wear everybody out until they finally take off on a run. The thing with CMG is at this point, you've already had a pretty big run, so I don't know if it's going to start another one, but I do know that short interest tends to be high on that one. It is a favorite among short sellers, but I wouldn't be shorting it here. It does look like it wants to go higher right now, but that's going to depend on the general market. The $300 rule, that's a possibility too. So, like I said though, I think it's going through 300. So using the Livermore Century rule, that might be viable here. And the key here is what you do is Livermore you use the round number as your stop. Also, in other words, if the stock starts getting up to 300, it should hold above it. When it doesn't, then you bail out. And you can see that with Biogen, that might have caused you to do the same thing here. You might have come into it here, but you would have bailed out. And then as it comes in, you try it again. And now this time you come in and it never looks back. So that's really what you're looking for, is the point at which it starts to move through that $100 or $200 or $300 mark and continues higher. So with CMG going through 300, yeah, it might continue higher. It might just flit around a little bit. But it's all going to depend on what the general market's doing. And let's see, I think that pretty much covers all our questions for now. We're at 11:01.
Here's that question I was going to get to.
Okay, last question.
Discuss market direction model as it relates to recent market volatility. I was wondering if you could do a segment relating to volatility spikes and effects on the market afterward in regard to being whipsawed. Well, yeah, because certainly this year has been a year of the whipsaw. I would say that the VIX spiked after May 2010, as we all know, during the flash crash, and markets often will remain in a volatile phase, which drive up the risk. Thus, the model does account for that, and it will create temporary rules to stay out of such volatile environments, or at least in 2010, after May, you'll notice that the model only had 2 more signals during, I think, a span of like 3 or 4 months, and those are very tiny losses. So in other words, if a buy or sell signal is issued during a volatile phase, it does account for that, and it might reverse the position sooner than normal. And if one were to act out on a buy or sell signal, one could do so using a smaller than normal position size. And I would say it's good to study big sudden corrections, such as May 2010, October 2008, April 2000, the September 1998 one, where the long-term capital disaster was going on, October 1997, that was the Asian contagion. You get the idea. And that will give you a sense of how the general market tends to behave after a sudden correction, and the VIX does spike in every case. So it's good when that happens, and you've captured. The model has a pretty damn good track record in terms of capturing the downside. And once it has that profit, and then goes back to cash, then it waits and sees. Just it's not very impatient in terms of getting back into the market. And after May of 2010, it was good that it was able to sit out more than sit in during those ensuing summer months.
I mean, obviously, we get the question, how do you know when the market's rolling over? What do you look for? Let's just go back to last year, and you can see basically what happens here is you rally up into moving averages on weak volume, and you might see a little pickup in volume as the market rolls over. And this will also coincide with your short sale target stocks rallying up into logical resistance. So we're seeing that right now with Apple. NTAP also ran into its 50-day and turned tail earlier today. You got LVS rallying up into its 50-day and so on. And so A lot of times the two will correlate together. You'll see the market rallying right up into an area of resistance along with your short sale stock. So for example, back here you see this area here. Okay, that's in early May after we had a big break and a big bounce. One of the stocks I was playing at the time was U.S. Steel, and you can see that at that time, let's see if this. You had a rally here, and this coincided with a rally up into resistance. It didn't get up to the 50-day, but it did get into resistance, and it didn't hold. So I'll actually come after a stock when it does that. And that coincides with what the index was doing at the time. So that you will have this correlations. It's not an exact science, and sometimes you may get stopped out real quick, but you may have to come back in and test positions. And I had to do that several times on any of these days where you see some of these rallies. FCX was another one. Back then that I played, and this is when I was up 100%. You can see that this actually failed right at the 50-day here, and then you broke down here, and you're starting to fail around the 10-day. And so a lot of this is kind of feeling where the two are, and a lot of times they will kind of correlate. You know, if you're up 3, 4, 5 days in a stock on a bounce off a low, a lot of times that's as far as it's going to go. So I'll use the 3-day rule, which can sometimes stretch out to 4 days. In terms of looking for a bounce and when something might become shortable. So, for example, if we're looking at a run, let me actually go to a normal type of chart that has NASDAQ volume. You know, you get 1, 2, 3, 4 days rallying, 1, 2 here, and then this one goes 1, 2, 3, 4, and then it comes in, but then here you go again. You got 1, 2, 3, 4 day rally, so maybe running out of gas here. But you kind of got to play with it. There isn't, you know, it isn't all hard and fast. It isn't black and it is something that you have to kind of feel your way through and be willing to take small losses and then come back after things. And you may get nicked with a lot of small losses, but if you catch something real nicely, you can shoot up 100% like I did in May 2010. So it's, you know, but that's kind of a personal psychology thing. I can handle that kind of stuff. I have deep pockets, you know. So I can get hit. It doesn't bother me to get hit 10 or 15 or 20% because I can withstand that sort of thing. So you really have to think about how heavy you're going to go in, where you're going to go in, and how much you can stand to lose. And in some cases, given how difficult the short side is, you may not even want to play the short side. It's much more dangerous. It's where I've taken my biggest losses, but it's also where I've taken some of my biggest and fastest profits. And I would have to say that even with my fiasco in 2009, if you take in May 2010, for me personally, I more than made up what I lost in my own fund during that period. And you know, if I hadn't had a bunch of dorks in the fund screaming and yelling and trying to make a scandal out of it, who knows? I might have been able to bring the fund back as well. But instead, we just shut it down. And I prefer to run a fund with Dr. K, he and I are much more compatible in terms of psychology. But you know, you just have to be ready for a lot of that and decide whether you are the type of person who can handle the psychology of being short and handling volatility. Okay, so that's all we got for now. We'd like to know if you guys prefer intraday webinars. You may notice we're a little more energetic. I tend to react to the closing bell in a strange way. I want to go to sleep. I don't know why. Something about the market's like caffeine for me. So you may notice we're a little livelier today, intraday. We may do more of these intraday. So it looks like people like intraday. All right, so maybe we'll do the next one intraday. And then we'll see what happens tomorrow, Thursday, when the Greek boat comes out. We'll see what shakes there. And so watch for me to put out some GoView webinars and put those out. I know it's not the most perfect system yet, but I think it's improving slowly, and eventually I think they'll have it all tweaked. On that note, you guys, good luck today. We'll see where this Greek thing goes. And catch me on Fox at 1:05 p.m. Pacific time. That would be 4:05 p.m. East Coast time, and 9:05 p.m. London time, where Dr. K is at. All right, you guys, take care, and we'll catch you later.
So long.